Have you ever felt like the stock market is trying to shake you out of your own portfolio? One day stocks are climbing, the next day they're crashing, headline screams, rate cuts, AI bubbles, or global recession. You check your account and boom, down 10%, or maybe more. And the next day it's up 10%. Oh, and I missed it. So that little voice starts whispering, should I sell, move to cash, wait until things calm down, or should I buy? Things are going up so fast. If that sounds familiar, you're not alone. Volatility triggers fear, and fear leads to bad decisions. But here's the truth. Volatility isn't your enemy. It's the price of admissions for long-term returns. If you know how to navigate it, it can actually become your superpower as an investor. In today's video, I'll walk you through 5 battle-tested strategies to help you survive and thrive through turbulent markets without losing your mind, your money, or your sleep. Hi, I'm Chen, former hedge fund manager, CFA charterholder, Wharton MBA, and founder of the Always Be Compounding Club. If you want to build real wealth without obsessing over headlines, I invite you to join our free online community at members.alwaysbecompounding.club. It's where serious long-term investors come together to grow, learn, and stay focused on what works. So let's get started. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you are responsible for your own financial decisions. Strategy number 1, build a bulletproof emergency fund. Before we even touch stocks, bonds, or ETFs, we need to start with a foundation, a fully funded emergency fund. This isn't just a financial tool, it's a psychological anchor. When the market is volatile, your emergency fund gives you confidence. When life throws curveballs, it gives you options. Ideally, you want 3 to 6 months of essential expenses in cash. If you're retired or drawing down your portfolio, go bigger. 12 to 24 months of cash or short-term treasuries in ETFs like SGOB or BIL. Why? Because when markets drop and headlines scream panic, your cash cushion means that you don't have to sell stocks at a loss just to pay your bills. It buys you time, and time is the ally of every great investor. Remember, what matters is time in the market, not timing the market. Strategy 2, embrace automatic investing. Volatility creates paralysis. Actually, it creates analysis paralysis. Should you wait for the bottom? What if I invest today and the market crashes tomorrow? Those questions are mental quicksand. And the antidote is automation. Set up automatic recurring contributions into your 401k, IRA, or taxable brokerage account, and allocate those funds to your chosen investments, whether that's a 3-fund portfolio or a dividend strategy. This is called dollar cost averaging, and it's powerful. When the market drops or dips, you buy more shares. When it climbs, you still keep on investing. It removes emotion, it builds discipline, and it keeps you compounding. Warren Buffett doesn't try to time the market, and neither should you. Strategy number 3, keep a portfolio that lets you sleep well at night. Let's talk about sleep, not stock picks, not annual returns. Sleep. Because if your portfolio is keeping you up at night, it's too aggressive for you. Your investing strategy has to be emotionally survivable, or it won't be sustainable. A portfolio that works for me looks something like this. Oh, please make sure you do your own homework. But for me, I have a core, which is a 3-fund portfolio made up of total stock market indexes or in bonds like VTI, VXUS, and BND. I have another segment that gives me stability, which is provided by dividend growth ETFs like SCHD or short-term bond ETF like SGOB. And I have an optional satellite composed of high-quality compounders like Brookfield, ticker BN, Berkshire Hathaway, ticker BRKB, and Alphabet, ticker GOOGL. Strategy number 4, tune out the noise. Here's a truth the financial media doesn't want you to hear. You don't need daily updates to build long-term wealth. In fact, the more frequently you check your portfolio, the worse your performance tends to be. Here's what I suggest. Check your portfolio at most once a week, maybe even just once a month. Limit your exposure to financial clickbait. Unfollow the gloom and doomers on Twitter, YouTube, and TikTok. Spend that energy reading and reviewing your investment plan instead. Ask yourself, has my time horizon changed? Have my goals changed? Has my portfolio drifted? If the answer is no, stay the course. Remember, volatility is the toll we pay for long-term returns. Strategy number 5, use volatility to your advantage. Now it's time to go on offense. Because volatility isn't just something to endure, it's a tool you can use. Here are 3 ways to do that. Rebalancing. Rebalance when certain parts of your portfolio outperform or underperform. You get the drift. Rebalancing lets you trim winners and add to undervalued positions. It enforces a buy low, sell high process. 2. Tax loss harvesting. In taxable accounts, use down periods to realize those losses and offset capital gains. Then reinvest in similar but not identical assets to maintain exposure. 3. Opportunistic buying. If you've had your eye on great companies like Pepsi, J&J, or Brookfield, volatility can give you a temporary discount. That's when long-term investors quietly go shopping. The truth is, volatility reveals what's fragile and what's durable. If you've done your homework and know what you own, a dip isn't a problem. It's a buying opportunity. Conclusion. Let's bring it all together. To survive and thrive in a volatile market, you need to 1. Build a cash buffer so you're never a forced seller. 2. Automate your investments to stay consistent. 3. Align your portfolio with your emotions. 4. Tune out the noise and focus on your plan. 5. Use volatility to rebalance, harvest, and buy. That's it. Simple, powerful, and repeatable. Now, if you found this video helpful, here's the next step. Join the Always Be Compounding online community. It's where investors like you, long-term thinkers, not market timers, come together to share strategies, ask questions, and grow wealth the right way. Inside, we dive deeper into portfolio construction, tax efficiency, behavioral traps, and long-term planning. Plus, you'll get exclusive tools and live Q&As where we dig into topics like the ones we covered today. To join, just go to the link below. And don't forget to like this video, subscribe to the channel, and share it with a friend who might be panicking in this market. Because compounding works best when we do it together. Stay calm, stay invested, and remember that the key to building wealth is to always be compounding. Thanks for watching. See you in the next video. Take care.